Good morning, Stackers. Happy Tuesday. Fun show yesterday where we went live and then we weren't live, and apparently we were still live even though we weren't live. So if you I think you heard me not only record some pre-rolls for the Stacking Benjamin show, which I know is very, very exciting. Very exciting radio or TV in this case. You also heard me do a car insurance claim. That's what we do here in the basement. Record new stuff and make car insurance claims. All right. Let's get ready to party for today. Oh, I didn't write out the agenda. So now in more exciting television, you're going to see me write out the agenda. Actually, you're going to see me stare right over here and write these out. All right. Our first headline about Twitter and replacing Monsanto in the S&P 500. And the takeaway there is takeaway we've had before with that. And then our second headline is on due diligence. And then our big idea, which is pretty exciting today. Our big idea okay, that's good stuff. All right, guys. Let's fire up the soundboard. That sounds good. Level's looking good. Back the microphone a little away from my mouth so I'm not shouting at you. Today's Money in the Morning mug. Ferrari. We're going Ferrari today. And for those of you who are here for the first time at the live recording, I know this is really exciting TV. We're about to get to it. Here we go. Live from Finance Town, USA, Texarkana, Texas. It's another episode of Money in the Morning. Hey kids, I'm Joe Saul-Sehy, Average Joe Money on Twitter. And today, Twitter. Hello, Twitter. You're in the S&P 500. Congratulations. Monsanto kicked to the curb. Why is Monsanto out? Why is Twitter in? What does that mean for your money? How does indexing work? We're going to talk about all that in our first headline. Then in our second headline, we're going to talk due diligence. A recent Inc. piece talks about buying a company in due diligence. But does this have something to do also with your personal finances? Yes, it does. And that's all today on Money in the Morning. Money in the Morning's brought to you by Tiller. You know, Tiller is mom's favorite spreadsheet. program. And if you are like mom and you're a spreadsheet nerd, you're going to want to head to tiller.com using our link, stackybenjamins.com/Tiller, because I'll tell you, Tiller is unlike any other spreadsheet program. Not only do you have the ability to manipulate everything, but you can also press the easy button when it comes to getting all the data you need, whether it's how much money you spent at the grocery store yesterday, what your investments are worth. That's all integrated at Tiller. Head to stackybenjamins.com/Tiller for more. All right, you've got places to go. We've got great headlines. So let's get this party started, shall we?
Hello, darlings. And now it's time for your favorite part of the show, our Stacking Benjamin's headlines.
Wouldn't be a live recording if I didn't totally mix up the bumper music. Speaking of that, we're getting some new bumper stuff coming. We started off in an exciting move to launch the Money in the Morning show. We used the Stacking Benjamin's headlines theme. We're getting a new one. And I'm so excited to unwrap that thing. It's coming in the next couple days. So stay tuned for that. I know you're super excited. That made your morning. You don't really need headlines, but we're going to deliver them anyway. So here's headline number one. This one comes to us from Fortune and is written by Haley Detrick. Twitter stock pops even higher on news that it will replace Monsanto in the S&P 500. A day after Bayer announced it would kill the Monsanto brand after its $63 billion takeover, expected to close on today, actually. S&P Dow Jones Indices announced that the social media company Twitter will replace Monsanto on the S&P 500. Likewise, Netflix is going to replace Monsanto in the S&P 100. Although the move will not go into effect until just before the market opens on Thursday, Twitter stock jumped as much as 5% in after-hours trading following the announcement on Monday. The announcement pushed Twitter stock to $39 a share in what had already been a good year. Growth in usership and profits have contributed to a 58% year-to-date increase in the stock and more than 100% year over year. Still, the choice is somewhat unorthodox, as the Wall Street Journal points out. Companies are supposed to have 4 straight quarters of profit before joining the S&P 500, and Twitter only has 2 following 16 quarters of losses, though the company expects to be profitable. Goes into Twitter, and if Twitter's a worthy company to be in the S&P 500, that's above my pay grade, kids. But what's not is this idea of changes to the S&P 500. So for those of you new at playing the exchange traded fund game or playing the index game, here's the way it works. Instead of buying a single stock, a great option for you is to buy a basket of stocks, which aren't managed, but they just follow one of these indices. And in this case, it's the S&P 500 that we're talking about. And the S&P 500 represents 500 of the biggest companies in America. And as you heard, they also have some restrictions. They're supposed to have 4 quarters of profitable years or profitable earnings period, there'd be 4 quarters before they go into the S&P 500. And that means, what that means is not only when you buy an index, are you getting 500 companies instead of 1, which is pretty awesome, isn't it? Instant diversification. One company goes out of business, who cares? You got 499 more. I mean, you care a little, right? You're not inhuman, but really for diversification purposes, you're okay with that. Not only do you get that, but also it's self-cleaning. And the self-cleaning piece, to me, is the really cool thing, because you see these people have these portfolios that just need to be weeded. You know, you give a garden needs to be weeded a few times a year. Pull out the weeds so the flowers can grow, right? So the plants can grow. Instead of that, I used to see when I was a financial planner, I'd see these portfolios that just so needed to be weeded. Like people hadn't looked at them forever. And I'd point to a stock and I'd say, why do you have this? I don't know. Why you still got that CD? Oh yeah, I should have gotten rid of that a long time ago. Opportunity after opportunity. The S&P 500, self-cleaning. So Monsanto no longer going to be a part of the S&P 500. In this case is for a good reason. It's because of the fact they were purchased by Bayer. It's not because everybody hates Roundup and how we have bodies full of Roundup, right? It has nothing to do with that. Now the Monsanto name, which everybody loves to hate, is going bye-bye. Now it's going to become Bayer Roundup. So now I guess everybody will hate Bayer. Is that the deal? We'll see what happens there. But Monsanto, as they go away, The S&P 500 then picks a company, in this case, a company really returning from the grave in a lot of ways at Twitter. There's a heartbeat at Twitter. Shocking, isn't it? And then you end up with 500 companies now poised to do decent stuff. And when a company's not going to do decent stuff for a few periods on end, you know what happens? They get booted. In this case, Monsanto didn't get booted. They got acquired. But companies do get booted from the S&P 500, which is awesome because less work for you. You just own the 500 biggest companies in America. You don't have to clean it yourself. It's a fantastic way to invest. And I love this idea of indexing. So indexing for the win in a lot of cases when it comes to your portfolio. That's headline number one. Let's say hello to our live team watching us on Facebook today. We do these in front of a Facebook audience, completely live, way different than our other show, Stacking Benjamins, where we re-record and we edit some more. No editing on this puppy. Going to say hello to Jennifer, who's in South Dakota today, or most days, I suppose, watching us. Eric is here. It says, first time joining in on the live taping. Where have you been, Eric? It's about time you made it. Glad you're here. Don is here with us today. Ben's here. Ben asked if Doug will ever host the morning show on Facebook. Everybody's asking about where Doug is. And we try to keep Doug out of the basement except when he's recording. For those of you new to the show, my mom's neighbor, Doug, is the self-proclaimed host of our other podcast, Stacking Benjamins. And Doug seems to think a little highly of himself. Doug's quite a dude. In fact, it's funny. We have, we'll let you hear it on that show. Good stuff. And Eric says he's been working. He has grown-up problems. Yeah, that's first world problem. That's not my problem. You should be here. Tell the boss what's important, Eric. Just say, listen, I've got money in the morning. Love to do whatever your thing is that makes a profit. But money in the morning is all about my time. Say that. I'm sure that'll go over great. Let's go to our second headline, which comes to us from Inc. This is a piece that normally on Money in the Morning we wouldn't talk about because it has ostensibly nothing to do with personal finance. Yet, it's our second headline here for a reason. Let's move. Jim Schleckesser wrote this piece. There's a different way to do due diligence when buying a company that actually adds value. Anytime you pursue making a new company acquisition, you need to run through the typical due diligence checklist as a best practice. It's not unlike what you do when buying a used car, where you try to ensure there's a clean title while having your mechanic make sure everything's running smoothly before you close on the deal. When you buy a company, you might have your legal counsel make sure everything looks clean while the CPA reviews the company's books. You'll likely also have your own operations team check out how the company's running and that you won't lose any customers once the transaction closes. Most buyers assume that once you check off those boxes, you're good to go, but they'd be wrong. It's been my experience that limiting your due diligence in this way only leads to disaster. Why? The trouble is nobody's thinking ahead to what's going to happen the day after the deal closes. If you want to help ensure that your acquisition's a success, you need to think about the due diligence process as more of an integration planning exercise instead. What I mean by this is that when I was running companies and we were considering an acquisition, I'd have my team, the lawyers, accountants, operations people, look at the company and then come back to me with the answers to two questions. First question was whether the company was clean enough to buy, per my checklist example from earlier. But the second question I wanted them to answer is, what are we going to do the day after we own the business and beyond? I wanted my team to come back with a game plan for the next day, week, 90 days, and year for what we do inside the business and who was going to do it. Man, is that powerful stuff. So let's talk about this idea, due diligence, right? So you go to buy a company. You're CEO of a company. What's the first thing you do? You send in people, you make sure the books are clean, you make sure things are going the way they should go. Here's my question. Are you doing due diligence when it comes to your personal financial plan? Because this idea of due diligence is a powerful thing. I love this idea of going through, inspecting the books, making sure things are running the way that you think that they should. I think that and you know, what's funny? It sounds so boring and it's so exciting. Like we talked about these gardens that need to be weeded, right? You don't just need the garden to be weeded once or twice. You never know when new weeds are going to appear in the garden. So doing your due diligence, looking through your financial plan, pretending that you're somebody who's going to go buy your company, right? Your personal financial picture. What's the first thing they'd tell you to do? I was listening to a thing this morning talking about how marketing what you do is every bit as important, if not more important, than actually doing the thing that you do. My time doing the thing that I do, I spend not much time marketing. It was a big aha. And it's a big, how is the company operating? But it's not just about that. I love the second piece that the author talks about, which is where are we going? I think it becomes a really, really powerful thing. It becomes super exciting. And that's the thing about investments is a lot of times we tell ourselves, hey, I got to buy the CD. Okay, what happens after we buy the CD? What happens after we buy the S&P 500 fund? What are the conditions that would cause us to sell this thing? Setting those up ahead of time. Love that. Love that idea. So I think our second takeaway is what's going to happen tomorrow with your investments. Not just what happened in the past, but doing your due diligence about your financial picture is all about, it's all about looking into the future and seeing what happens then. All right. In just a second, we're going to take these two headlines. We're going to put them together in the amazing part of the show called The Big Idea. And before we get to the big idea, just got to say a big thanks to everybody who's used our link when they've gone to Tiller. Tiller's mom's favorite spreadsheet place. If you're somebody that loves spreadsheets way over using your little smartphone app like I do, smartphone app not strong enough, you want to be able to manipulate the data however you want, head to stackingbenjamins.com/Tiller. And the cool thing is not only if you purchase Tiller, will you end up with that spreadsheet program you want, you also help the show. So thanks to everybody who's done that. All right, today's big idea. Let's look backwards through our two headlines because we had some good ones today. The first one, Twitter replacing Monsanto in the S&P 500. And our takeaway is that indexing is self-cleaning. Not only is indexing a great way to get diversification, but also when things aren't working out with a company, you end up with 500 companies that are the biggest, some of the strongest companies in America. This index is made to continue to perform without you having to do much. Good stuff there. And then second, this idea of due diligence, not only big when you're purchasing a company, but it also can be huge in your personal financial situation. And the question you have to ask yourself is not just what happened before I bought this investment, how good has it gone so far, but what happens after I buy it? What are the conditions where I need to sell? When am I going to sell? What's my sell discipline? What if things change with the investment that I buy? It's a big piece of owning any investment. But there's this big idea that's kind of implicit in both of these headlines that I really want to bring to the forefront for today's big idea, kids. And that's that there are these things called energy drainers that my coach talks to me about all the time. And energy drainers are the clutter in your life, right? And we talked a lot today about weeding the garden. And it's not just that the weeds create less performance. It's that every time you look at that weed and you don't pull it, your brain stumbles over it. And instead of being on point, instead of being on task with that one thing that's going to move you ahead, you end up stuck on this weed. Man, I should pull that weed. Not sure about that weed. I've got a thing going on in my life right now that's a big energy drainer. I put it off every stinking day because it's complex and I don't love complexity. And you know what? I know that energy drainer, getting rid of that thing, is going to make me go forward so much faster. Maybe it's important for me to have just said that out loud. Maybe you need to say it out loud to somebody. Get rid of those energy drainers, like my coach says. A lot of the time, we just want to focus on the things that we're good at, the things that are easy for us to do, the things that are our unique talent. That's great. But removing those energy drainers, those clutters, whether it's clutter in your investing program, clutter in your work life, clutter around the house, clutter here in the basement, get rid of that. And I think you go a lot faster. Thanks everybody for hanging out with us today on Facebook. Thanks to everyone who is hanging out at home, wherever you are listening to this podcast. Thanks to everybody who has left a review of the show. I'm Joe Salcia. I will see you back here tomorrow. Go stack some Benjamins. Bye-bye.
Money in the Morning is created by Joe Salcia and is brought to our channels by our producer and engineer, Richie Rutter-Reese. Stacking Benjamins and Money in the Morning are for entertainment purposes. Before making moves, consult with your financial advisor. Looking for training sessions? Kathleen Sellemans has a great suite of Stacking Benjamins tools, so head on over to learn.stackingbenjamins.com. Hoping to chat with us on the web? Say hello to Shannon Cowan, our social media guru and community manager in our Facebook group. She can be found at stackingbenjamins.com/basement. From the basement, I'm Joe's mom's neighbor, Doug. See you tomorrow.
All right. How fun was that, huh? Thanks. Small group today. We today are working on a great show for tomorrow. Aja McClanahan moved her family to a place that she calls the hood. In her interview, there were bullet holes in the door, and she got this house for free because her family had no money. I made the decision to move her family into this house, and just the story of her move and getting out of debt. It's a pretty powerful thing. So excited to have her on tomorrow. And we're also, for a future day, we're putting together a roundtable, a special roundtable for the Stacking Benjamin show that's teaching kids about money in the summer. So summer months, we're a little bit behind the eight ball there. We've got lots of parents that are already out. But anyway, teaching money lessons. So good stuff there. That's what we're working on today here. Hope you guys have a great day. We'll see you later.